But with that, we can move into our main topic. And the main topic is also regarding a opinion article to kick us off here. So for those of you who are also new, you can find the articles that we discussed in today's episode, not just on stomarket.com/news, but you should also be able to find it in the description of wherever you're listening to the podcast on. And you should be able to find a nice little Forbes article. It comes from a previous property developer and prop tech investor who writes for the Forbes Real Estate Council. And this article highlights the future of real estate investing being, of course, digital securities and tokenized real estate. And we've obviously covered the subject, but the op-ed does do a good deep dive, I'd say, with more of an industry veteran evaluation. And of course, chief among them are the benefits of the investing experience and even the home buying experience, just in general, how blockchain covers the scope. Today, though, we're going to cover one of those major benefits in more detail, specifically fractionalized ownership, which we think is one of those biggest value adds. I'm going to hand it over to Kyle to help break down exactly what that process looks like today. What does fractional ownership for a real estate asset look like versus, going into the actual benefits of the technology?
So fractionalized ownership is one of those buzzwords that got thrown around in the crypto space as a lot of people were transitioning to security tokens as one of those benefits that might exist. It's one that we've fleshed out in much detail with many of the successful companies, especially here in the real estate space. But it is important to note that fractionalized ownership is something with real world assets that is technically it's possible today. It's just time consuming and costly. And some of those examples include the fact that real estate can actually be currently fractionalized via an exemption called tenants in common, which allows for multiple owners of a property to manage that together. It's something that is used, is seen. The problems arise actually regarding managing and dissolving the TIC, tenants in common exemption or regulation, however you would like to call it. And this is because it is transferable to your estate, but dissolving it requires actually a separate agreement that needs to be renegotiated. It also can lead to mediation and pieces like this that are just very bulky, a lot of in-person, a lot of paperwork. And so not super efficient capital markets for sure in the real estate markets. Additionally, you may be familiar with timeshares, right? This is an example of something where you buy into a piece of the property and it's highly regulated by whoever's issuing the timeshare, and oftentimes you get stuck with a couple weeks in some random undesirable month to own this property instead of maybe when you might have wanted it. It also is known to be a low quality investment just because of its illiquidity and rigidity, in the sense of you own this timeshare, but you can only use it at a specific month or week that maybe if you don't want it too bad, you're going to need to find somebody to purchase that from you and you're locked in. So timeshares do exist. Again, another example of fractionalized ownership, but one that really doesn't capitalize on what those benefits may be.
Last example I'll give you is the traditional marquee assets and or large scale projects where we're talking about putting together $100 million, $500 million valued buildings, whether they're commercial or even apartments and condo buildings. Those can be traditionally difficult to access simply because they have a very high requirement to invest and participate, and therefore it was limited to basically the institutions and the funds that were in that space.
I also wonder if there was a robust liquidity pool there as well. There may be some issues with that in
Definitely an inefficient, let's call it, market.
So when we look at how that would work with security tokens, the reality is that what you can do is you can divide the ownership of a property into shares of a security token. And so you would divide that into as many shares outstanding as you're looking to do. And smart contracts actually allow for the ease of transaction between those buyers and sellers. And so that includes the agreements being online and secured by the blockchain, as well as pre-programmed and automated compliance, and also for secure payment systems and the transactional piece of it. So a lot of those heavy paperwork pieces, a lot of that legal protection actually can be automated and really built in such that a specific buyer or a specific seller doesn't necessarily need to draft all these documents again for each property, which they all have their standard agreements. Why don't we build these things in so that you just need to fill out one piece of it and then the rest is executed through a smart contract that can then be shared amongst all of these different properties. And so on top of that, the investors, once you've invested, are then returned the equivalent fraction of the future sale price, right? So there's a couple ways that this might work in terms of if you're investing in a consortium or a portfolio of real estate properties and are potentially returned dividends yearly or quarterly based off of how those assets appreciate or if some are sold. We've also seen examples of a specific asset, and if that thing gets sold or transferred, then the tokens are dissolved and the return profits then go to the specific investors, or even in some cases where that token maintains and persists over time. So there's a lot of different examples that's all kind of in the structure of the deal, which goes back to that question of rigidity or flexibility. And so with a security token, whatever the demands of the investor or the issuer are, they can structure this thing in a way that makes sense for everyone. And as long as that's clear and, again, pre-programmed and determined from the beginning so that nobody can just kind of go back later and say that it was something different, with a secured contract in that regard, it can be incredibly efficient and allows for many new investment vehicles.
And of course, you're talking about the entire process you just described now being an entirely digital one, which almost all the time is currently completely analog. Hence why it's also very difficult for these types of projects to get a global audience. The reality is it's typically focused on a local subset of investors. And now, with it being a digital process, all of that governance and compliance can be embedded into a digital manner so that it can be accessed globally. And I think the overall trend that we're talking about here is when you're giving issuers a lower cost of capital and an overall lower cost per investor to manage, you are making it so that they can lower their overall investment threshold, enabling more individuals who previously couldn't access those minimum investment threshold requirements, right? And so now you can globally access more people, you can access more people in general, you can manage them all in an even easier format, and therefore you really have the true value of fractionalized ownership. And it's not just us two saying it, right? We've proven that here with the news that we're hearing. MBK, specifically out of Tokyo, said that the real reason that they're doing it is for fractionalized ownership, because this enables them to get their clients more diversification, because now they can allot their portfolio into more real estate projects as opposed to being concentrated into just one.
It allows for a more diversified market for real estate. It allows investors to participate, as you mentioned, in the two key ways. They don't need to offer quite as much capital, which again is less risk for them. It might make them more inclined to invest because of the capital requirements are lower. And also it allows for them to have a shorter time horizon on investment because of the fact that these are more efficient capital markets. These, in theory, should be able to be sold and bought with less premiums or discounts than in traditional markets because of some of the things we've already discussed. It allows them to feel more confident in owning these things around the world. You can have international investors from anywhere around the world investing in any properties they want, whether it's homes or whether it's commercial real estate or incredibly large institutional properties. Now anybody can invest in these things, which allows for I think it also helps with the volatility of the market as well, because now you're more diversified over more people and have more diversified capital, which is just good for markets in general.
Well said. I mean, it's funny, the more liquidity you have for the asset, the safer or less risky it is, and the less risky it is, the more appetite there is, and the more liquid it eventually becomes. So that's what's happening here. We're going to see a proliferation of real estate assets across type as well as geography in the next few years. The article in the opinion article, the author said that by 2025, they themselves think that a majority of all real estate transactions will be tokenized. Let's see if they end up being right. Certainly I'm bullish. I think Kyle's bullish too. Hopefully you are too. Let us know your thoughts, your comments. Tweet out to us. Reach out to us on LinkedIn. message us and reach out to the community on STO Market. And with that, that's our show. Thanks for listening.